Hi, my name is Kamal. I've actually been following markets, especially the US markets, for the last 15 years. I've now decided to record my comments on what's going on in the market on a regular basis. This is the first of a series of YouTube videos that I will record. I will try and be regular, dependent on the kind of time that I make available from the work that I do. This video is being recorded on 12th June and will capture the commentary on the market for the last week, which means starting Monday, 6th June till Friday, 10th June of 2022. What happened in the market? Both S&P 500 and NASDAQ went down. S&P was down 235 points for the week. NASDAQ down 860 points, both closing on a weekly candle basis at the lower Bollinger Band. That means that both S&P 500 and NASDAQ Composite are facing significant bearish technicals and the sentiment is down. NASDAQ is already in bear market territory and has been there for some time. Bear market territory historically has been defined as when the markets are below 20% from their all-time highs. S&P came close to bear market territory on 20th of May when it just about fleetingly brushed intraday below 20%, but closed higher than that, somewhere down 19.4, 19.6%. But given what's happened this week in the market, it's very likely that S&P 500 will test these lows again and could go into bear market territory. Also, what is important to note is that S&P 500 gapped down on 2 days back-to-back, Thursday and Friday. Thursday was in anticipation of a hotter than expected CPI report, and Friday when the actual hotter than expected CPI report actually materialized. So what's this hot CPI report? Basically, CPI came at 1% for the month of May, which was higher than the forecast of 0.7%. Core CPI came at 0.6%, which was higher than the forecast of 0.5%. Net-net, core CPI is up 8.6% for the last 12 months, higher than 8.3% in April, and this is the highest 12-month CPI number since December 1981, so going back almost 40 years. Core CPI excludes food and energy. That's how the definition is. And that was also at a very high rate of 6%, unheard of. The only thing to feel a bit happy about, or potentially feel less agitated about, is that core CPI came down from 6.2% in April and 6.5% in March. However, for a US consumer, it's the overall CPI which makes a difference to their living and makes a difference to their expenses for the month, the household expenses for the month. The reason why that has been high is because the food index and the energy index both have been very, very high. The food index increased more than 10%, 12 months ending May 2022. Now, this is important for a US household because it is biting into the money that a household has for expenses in a month. And given the continued war in Ukraine and continued pursuing of China with the zero COVID policy, it is not clear to the market that these inflation pressures are going to ebb anytime soon. What are the implications of this, and what else happened as a result of this hotter than expected CPI report? The first is that rates climbed. The 10-year US Treasury climbed and the 2-year Treasury climbed. The 10-year climbed to 3.16%, the 2-year climbed to 3.06%, and the spread between the 10-2 went down to 10 basis points compared to 27 basis points at the start of the week. This signals potential yield inversion. There was already a yield inversion between 10-2, which had happened, a few weeks back. There are some parts of yield curve which have already inverted, especially, the 5 to 30-year Treasury yield has actually inverted. Yield inversion is an important phenomenon because effectively that dries up liquidity in the market and signals economic slowdown. The reason why it dries up liquidity in the market is because financial institutions feel that they have no incentive to lend for the long term because shorter term rates are much higher or somewhat higher than the long term rates. And that reduces liquidity for long term borrowing. And liquidity reduction is effectively what drives economic slowdown and recessions. What also happened is that there's something called a University of Michigan consumer sentiment, and this has been measured in the US since 1978. This University of Michigan consumer sentiment measures how the US consumer is feeling, and its number for this week came at 50.2, which is the lowest ever number since 1978. That's when this index started being measured for the first time. Imagine, lowest than 1978. So lower than what happened in the dot-com crisis, lower than what happened in the financial crisis of 2008, lower than what happened during the COVID pandemic of 2020. The US is a consumer-driven economy. It's an economy where economic activity is very much driven by local consumer demand. And a US consumer which is not feeling happy. And actually, the outlook in this University of Michigan consumer sentiment was 46.8, which is, from my perspective, the lowest I've ever seen. The US consumer is just extremely, extremely not sanguine about the future, extremely unhappy and concerned about the future. If this is anything to look at from a signaling perspective, this would signal slowdown in US consumer spend, which will, in addition to declining potential liquidity with yield curve inverting, signal further economic turmoil, further economic slowdown, and potentially a recession. Now, what is a recession? Historically, in the US, 2 consecutive quarters of negative GDP growth have been defined as a recession. In our case, the first quarter of 2022 was already negative on GDP. The second quarter expectations from the Atlanta Fed are at 0.9%, and they seem to be declining. If further revisions happen, and if Q2 GDP numbers for the US are also negative, we might already be in a recession. And it's just that markets are still not fully clear on it. And that's true of every recession. In most recessions, people have realized that they were in a recession much after the recession passed. And this could also signal potentially S&P 500 also going into bear market territory, which means hitting the threshold of 20% close from the all-time highs. What is much more important to note is that this continued pressure on inflation or continued high numbers on inflation means that the Fed put is nowhere in sight. For the last almost 40 years, ever since the Greenspan era, what's really driven markets is a belief that the market had the Fed's back, and there was always going to be some level at which the Fed would come back to rescue the market. That Fed put is no longer there. This is a fundamental shift. This is a paradigm shift. And with inflation running scorching high, it is unlikely that the Fed put is going to come back in a jiffy. This means that the market will continue to be on tenterhooks. Every high inflation number will make the market feel even less sanguine and lead to lower and lower numbers in terms of what the indexes show. Also, it seems that the current Democrat government, the current presidency, and a Democrat-controlled House and possibly the Senate are all of the view that inflation is the biggest consumer issue at this point in time, talking continuously about lowering the inflation numbers for the Fed to act. The US President Joe Biden again pointed fingers at the Fed for a higher than expected inflation number and gas prices being abnormally high. Given this, the Fed will continue to be under pressure to moderate inflation, and they do it by increasing rates. So that's what we should expect going forward. In addition to the US markets, other parts of the economy, especially those which are extremely speculative in nature, that is cryptocurrencies, have also been seeing a dramatic shift in sentiment. And in the last week itself, Ether and Bitcoin both went down. Ether at the time of recording this video is below 1500, and that is a real low number. All the other coins are also low. Bitcoin is holding up a bit. It's below 28K. We'll see where it goes. The other coins are all in a downward spin, and there is no bottom in sight. This signals a total risk-off mindset, because I would argue that cryptocurrencies signal the most speculative end of the market. And if the market was beginning to shift its momentum, the first place where you would see the resurgence in prices or price market action will be cryptocurrencies. What should one expect in the week ahead? We all know that there is an FOMC meeting happening on 14th and 15th of June. The CME FedWatch tool actually shows a near certainty of a 50 basis points increase that the Fed will do, and the effective Fed funds rate will move to 125 to 150 basis points. The probability of this event is like more than 96%. So therefore I said near certainty. I think while this is expected, what the market would really look out for is the language which the US Fed, Jay Powell, actually uses in the post rate announcement discussion. He could point out as the moderation in core CPI as a way that things are improving and there is a peak inflation narrative, or he could choose to sound extremely hawkish to try and convince the market of the Fed's total resolve and unflinching resolve to tame inflation. Now, what is it that I think? I think sustained high CPI numbers are now being driven more by supply factors than by demand factors. When I say supply factors, the supply factors are causing increase in energy prices and food prices, both driven by the Russia-Ukraine war. And other parts of the CPI or other elements of the CPI facing pressure due to shutdowns in China, which continues with its COVID policy of shutting down even if there is a single case. The zero COVID policy, as China has got to be very well known for. Whatever was the demand side inflation or whatever was the contribution of the demand side to the inflation is already coming down or has already mitigated quite significantly. We have seen the lowest University of Michigan consumer sentiment numbers in over 40 years. So the real issue on inflation is that it is probably now more of a supply side issue, and the demand side issues have either dried up or are drying or are going to dry up very soon. And it's important to note that the Fed has no control over the supply side. The Fed can actually only control the demand side of the inflation. What should one expect from the Fed? Look, it's already expected that the Fed will increase the rates by about 50 basis points. My view is that if the Fed does so, the markets will continue to go down because there is no end in sight. And the worst thing that markets is lack of certainty. And a 50 basis points increase is not going to give the market any confidence that the inflation narrative is changing. What happens if the Fed is more conciliatory? What is meant by more conciliatory? It's unlikely that the Fed will increase the rates by 25 basis points or less. Very unlikely. I don't think that will ever happen. But the Fed could sound more conciliatory in the post-rate announcement discussion. My view is that if the Fed and the Fed chair Jay Powell sounds more conciliatory, that's also not likely to assuage the market any bit. Any discussion on core CPI, plateauing and there being a peak inflation narrative, I doubt very much if that is going to assuage the market or make anybody feel better. So that probably will be a no event, and the market will continue to keep moving down. What happens if the Fed increases the rate by 75 basis points instead of 50 basis points? My view is that this may actually trigger a reversal in the momentum, which is downward currently. I think accelerating the expected rate increases, the market already expects rate increases going up to 3% by end of this year. And if there is an acceleration of that, and if the market feels that the Fed is really determined to fight the inflation narrative, it is quite likely that there will be a short-term decline, which may take the S&P into bear market territory, but also very quickly signal the bottom of the market, because it would be now very clear to the market that the demand side issues have absolutely dried up and they aren't going to contribute to inflation anymore. There'll be total conviction on that. And from there onward, it's only the supply side narrative. And there things can only get better because, China will only open up from here. And there might be, some change in sentiment and some change in the ground reality in the Ukraine-Russia war. So a more hawkish Fed, in my view, could actually lead to a short-term decline for sure, but potentially signal a market bottom. We don't know what will happen, but that's at least my view. Let's wait to see. Remember the dates, June 14th and June 15th. June 15th is when the rate announcement will happen, and we'll have a post announcement conference. Thank you. You can follow me on Twitter and Telegram, both at my handle, which is @1RajKamal. Thank you.